Hello guys, it's me Justus. Welcome to Finance with Justus. Today I'm showing you the top 5 stocks I would currently buy right now. Of a number 1 stock, I bought a few shares after the market dip today after the CPI report. Did very well so far. I mean, the market rebounded pretty quickly for some reason, so yeah. I'll be starting from the number 5 to the number 1. You're gonna have 2 US stocks, 2 Chinese stocks, and 1 very little known European stock. If you know that, I'm proud of you for knowing a lot of stocks. Beginning with the number 5 is Intel, the value investor's dream. You have heard of it. It's everywhere on YouTube. First of all, I'm always going to give you my target price, the current upside, and the current price. My target price for Intel is $37.40. That is currently a 40% upside from $26.40 that we're having right now. First of all, about Intel, it's a big chip manufacturer, of course. The problem is currently that they're losing competition, with especially AMD taking market share, and also just right now, a slowdown in the chip market and a lot of delays in release. To the slowdown in the chip market, TSMC actually announced they're gonna cut investing by 10%. So that is very interesting, with especially Intel doubling down on investing. Because Intel is currently modifying its business model. Currently, it is producing chips for itself and also very tiny for others in the foundry business. They're currently investing billions to start foundries all over the world. So that is a very interesting project, especially with the current China-US trade war about chips starting. Locally developed chips will be very important and are being subsidized very much. Even here in Germany, there's currently one Intel factory being built. Until 2025, it will be basically eating up all of their free cash flow. That is a massive problem for them, especially because that means there will be no buybacks. Intel has been the historic king of buybacks. That will not happen. If you buy Intel for the buybacks, forget it. It's not gonna happen. For the next 5 years, it's all about growth. Investing in growth. Why I like the stock a lot is that the downside, in my opinion, is very limited. Even with AMD taking away market share, even if the foundry business flops, it will be money that was wasted in them, but the core business will still be there. If I would want the best downside protection, this will be my number 2 on the list. The number 1 would be the European stock that I'm gonna talk about. This is the European stock. Number 4, Heidelberg Materials. Maybe you know it as HeidelbergCement. They recently changed their name. My target price is $70.40.17. It has an upside of 81% from the current $41. This is a building materials producer from Germany, but they're globally diversified. Management has been increasing return on invested capital very successfully. Return on invested capital shrank a bit in the last few quarters because of the giant energy crisis globally, but I'm not really blaming the management there. One thing that differentiates them from others is they're becoming an eco-friendly materials producer, and they're very big into reducing their carbon footprint, which they've been very successfully on, which is especially important in the European market. They return a lot of capital to shareholders. They've been buying back a lot of shares and are paying it big dividends right now. You would think, oh, building materials, that has no moat. Yes, they do. What is very important about building materials is transportation is expensive. So you have a local monopoly wherever you have your plant. They have been able to raise their prices successfully without a big fall in demand. So that is very great. So I think as soon as the energy crisis is over, I think this will go very high. This is the number 1 company where the downside is limited. Even with my calculations, if the revenue grows by 0% from my starting point, it will still turn out a profit. Would this even be a value investing video without Alibaba? Like, come on. My price target for Alibaba is $138.22 a share. That is an upside of 84% from the current $75 it's trading at. The e-commerce giant of Asia. It is bigger focused on business to business, especially here having higher growth rates international. Before, the China segment was always growing faster, but now the international market is actually becoming more and more important for Alibaba. It is currently investing a lot in smaller growth projects to take back market share from its competitors. If you look at the market share over time, Alibaba is losing market share, which is normal and to be expected. They had such a giant part of the pie. If you think about Apple in the USA, how much of a hold they have there, they were even bigger in China. You cannot hold that. Not even Apple can hold something like that in the USA, so it was obviously gonna go away a bit. Those growth projects are currently eating a lot of money, and they will continue to eat money. The same thing is currently going on with the cloud business. It is still a very fast growing business. They're having a few issues in the last quarters, especially with ByteDance, the owner of TikTok, changing its servers from Alibaba away. What I love about Alibaba though is capital allocation. This is the usual problems with buybacks. They happen at the wrong time often. But the management of Alibaba executed it perfectly in my opinion. As soon as the stock dropped a lot, they bought back a lot of shares. They bought back around 3% of the company in 1 year. That is a solid buyback program from a company that is still investing a lot of money, a lot of money into growth. What I also like about the company is that the solid logistics divisions it's building up. It is still slightly unprofitable. I'm not gonna use the EBITDA margins that the company gives us. I despise the word EBITDA, but that's the most reliable measure we have from management to show how it's developing. With the recent real estate cooldown, of course, and the zero COVID policy, China's economy is softening. But once that rebounds, Alibaba will also do a lot better. Every time you're going to talk about Asia, you're going to have Taiwan in there. What happens if Taiwan gets invaded? I do not believe it will happen. If it will happen, I will see what I will do with my Alibaba share. Number 2, Tencent. My price target here is 61.30 with a 95% increase from the current 31.50. This is a company that I love because I use it personally a lot. It is the gaming giant. I love to play video games. It owns a lot of big studios. They're not only into gaming, they're big in social media in China. They're WeChat, they're QQQ, they're number 1 in long-form video, they're number 1 in news, they're number 1 in music, they're number 1 in literature. They're also number 1 in mobile payments with WeChat Pay. They also have the number 1 mobile browser and mobile security. And they're the number 2 public cloud provider behind Alibaba, of course. So this company is not only gaming, it is widely diversified, but it is still resilient. Actually, the fintech business has been outperforming the gaming business in the last few years. Of course, with social media advertising, it took a massive hit. Like Google, like Facebook, they stopped growing and even declined by a bit for 1 year. They invest in great companies. They have a very good track record at deploying the capital. Overall, a great diversified company, many big names, so great mode there. Number 1, Meta Platforms. It is the biggest part of my portfolio. 57.75% of my portfolio is currently invested in Meta Platforms. I can already see the comments. I would love for you to give your critics about Meta Platforms, even about all the other companies. I would probably imagine also Alibaba, Tencent, and Intel are gonna get a lot of fight back from you guys. But still, I would be happy with that. Discussing is what we're all here for. That's why I have this YouTube channel. My target price is 273.28. It has an upside of 110%. From 130. It's a free cash flow machine. It has a great mode through the network effect. For you guys who don't know it, network effect is basically the more users on a platform, the bigger it becomes because they're all connected. For example, even if a better chat app would exist, you wouldn't switch away from WhatsApp because your family's on WhatsApp, your friends are on WhatsApp. Especially in the European market, I heard in America, WhatsApp is not that big, at least under Americans. I heard under immigrants is bigger there, but here in Europe, you communicate over WhatsApp. You don't communicate over anything else. It has a proven track record of staying relevant. They said Vine would kill Meta. They said Snapchat would kill Meta. They're great at staying relevant. Even Facebook is still relevant under the adult population today. They're still growing users. They're still growing their users, and nearly everyone uses one Meta product. And they're still able to grow their users by 4% last year, year over year. Think about it. Who of you knows someone who doesn't have Instagram, Facebook, or WhatsApp? Like, everyone has at least one, and they're still able to grow users. That's what's fantastic about them. One issue they had in the last quarter was that the price per ad shown decreased by 15%, but it was partially compensated through an increase of 15% of shown ads. So kind of evened out. Recently it was shared how many hours are consumed on TikTok and on Reels. Reels is the competitor to TikTok in the Instagram app. Recently it came out that TikTok had around 11 times the hours watched than Reels. In my opinion, it won't end on number 1, but it is a strong competitor. And what's important, it's currently under-monetized. They're showing very little ads, just like stories. Instagram Stories was at the beginning very under-monetized, and now it's one of the main focus drivers on Instagram. You gotta think about that. Reels can become that. One thing I'm also focusing on is that TikTok's parents, ByteDance, recently released some earnings, and they're not making a profit. And I don't use TikTok anymore. My friends who use TikTok are already saying there are a lot of ads, and that is making me question whether TikTok at the moment can be a profitable company. Of course, this is a bit what if. I do not count on TikTok failing. I'm not saying, oh, TikTok will fail and all of the problems will away. TikTok will be a strong competitor. I think once the ad market eases a bit, this company can just have great growth again. One thing that is important, I do not calculate the metaverse in here. The reality apps section is very small, a very small part of Meta, and I'm counting on it failing here. I have not taken anything in from Reality Labs. It is currently burning cash at 2.5 billion per quarter. It is an interesting field, but it is so high risky that I'm not putting it into this. So if you invest in Meta, write it off. Think about it, this will never happen. You can be like, oh, it's a nice bonus if it happens. It can be a massive opportunity, but just write it off. It's the same as if you would be investing in Apple to see Apple car succeeding. It is not even there yet. You don't know if it works. You don't know anything about it. Do not count on it working. Always count on what you know can happen. This is the differentiation between speculating and investing. I'm investing in Meta, the company, in social media. If you would be buying Meta for the metaverse, you would be speculating on Meta, the metaverse company. Let me know in the comments, do you own any of these? I own all of these. Just a disclaimer again. Have a good day.